What happened this morning at 9 a.m. was not just a price breakout. It was a surrender. While the mainstream financial media was busy debating whether silver was expensive at $30, the physical market silently crossed the forbidden line of $66.40. But the price is not the real story here. The number on the screen is just a lagging indicator of a much more terrifying reality occurring behind closed doors. The real story is what the United States Mint did in response. They didn't ramp up production to meet the frenzy. They didn't issue a press release celebrating demand. They quietly slammed the brakes. Reports are flooding in from authorized purchasers, the wholesalers who buy directly from the government, that allocations are being slashed and the window to source sovereign bullion is effectively nailed shut. If you think you can simply log on and buy American Silver Eagles at the screen price today, you are about to discover that the buy button has been disconnected from reality. Welcome to the silent default. This is the moment where the price goes vertical, but the metal vanishes. By the time this video ends, you will understand why $66.40 is not a top, but a desperate floor. You will see why the supply chain between the mines in Mexico and the vaults in West Point has snapped. And you will understand that we are no longer in a market of price discovery, but in a theater of rationing. The paper market is still trading contracts, but the physical window has closed. Let's step into the darkness and look at the ledgers. To comprehend the magnitude of this shortage, you have to look past the spot price and look at the blank crisis. The U.S. Mint does not make its own silver planchets, the blank metal discs that are stamped into coins. They rely on private suppliers, primarily the Sunshine Mint. When the U.S. Mint halts sales or puts distributors on strict allocation, it is not because they forgot how to stamp coins. It is because their suppliers have nothing left to give them. For years, we heard the same excuse. It's a production bottleneck. They claimed it was a labor shortage, or a machinery upgrade, or a COVID hangover. That lie has finally run out of runway. You cannot claim a production bottleneck for 5 consecutive years while demand hits historical records. What we are witnessing is a geological cliff. The suppliers cannot source the 0.999 fine silver grain needed to create the blanks because the industrial complex has vacuumed the market dry before the mints even get a phone call. We are seeing a kinetic war for ounces between the government's monetary demand and the strategic industrial demand. And the industry is winning. This brings us to a mechanism that the banks have used to hide this reality for decades, the ETF illusion. Millions of investors think they own silver because they bought shares in SLV or other paper derivatives. They believe there is a vault with their name on it. This is the greatest sleight of hand in financial history. The prospectus of these funds allows them to lease silver, to swap silver, and to count encumbered bars as part of their inventory. In a crisis, these funds are designed to liquidate in cash, not metal. When the U.S. Mint runs out, the ETFs will be exposed as empty shells. The authorized participants who manage these funds are the same bullion banks holding massive short positions. They use the metal in the ETFs to short the market, using your own capital to bet against the price of the asset you think you own. But the halt at the U.S. Mint signals that this shell game is ending. You cannot rehypothecate a physical silver eagle. It is either in your hand or it isn't. But let's go deeper into the psychology of this moment, because it explains why the price is accelerating. In previous bull markets, like 1980 or 2011, higher prices brought out supply. When silver hit $50 in 2011, lines formed around the block at local coin shops, not to buy, but to sell. People melted down grandma's tea sets and sold their old jewelry. The scrap supply flooded the market and capped the price. Look at the market today. At $66.40, the lines are forming to buy. Dealers are reporting that for every 1 ounce coming back into the shop, 50 ounces are leaving. The public psychology has shifted from profit-taking to safe haven panic. They aren't looking to trade silver for more dollars. They are looking to dump dollars for any hard asset they can find. The scrap supply safety valve is broken because nobody wants the currency anymore. This removes the only ceiling that existed on the price. The financial system thrives on opacity. They rely on you not understanding the difference between a paper promise and a physical asset. They rely on you trusting the official inflation numbers and the official spot price. We don't read the news. We dissect the ledgers to find the lies they are trying to bury. If you want to be on the right side of the greatest wealth transfer in history, make sure you are subscribed to this channel. Now, Let's look at the specific number, $66.40. Why here? Why now? This isn't random. Adjusted for real inflation. Using the CPI metrics from 1980, not the watered-down fabrication the Bureau of Labor Statistics feeds you today, the 1980 high of $50 an ounce would be well over $150 today. At $66.40, silver is still historically cheap. It is the most undervalued asset on the planet. But the banking cartel, the entities holding massive short positions on the COMEX, have defended the $30 and $50 lines with billions in paper leverage. They threw every contract they had at the market to keep it suppressed. They utilize high-frequency trading algorithms designed to spoof the market, placing massive sell orders to trigger fear, then canceling them before they execute. For years, this worked. They could paint the charts to look bearish. But the fact that price just ripped through $66 tells you one thing. The algorithm is broken. The physical buyers, the sovereign wealth funds, and the industrial giants stopped looking at the charts. They are buying regardless of the technicals. The banks are out of ammo. The short squeeze isn't coming. It is happening in real time. When a commercial bank shorts silver, they are promising to deliver metal they do not have at a price that no longer exists. As the price moves $10, $20, $30 against them, their margin calls explode into the billions. They have two choices: add more cash to hold the losing position, or buy back the contracts and admit defeat. Buying back the contracts drives the price even higher. It creates a feedback loop of destruction for the shorts. We are watching the capitulation of the paper price managers. But the danger for you, the individual, is not the price. It is the unobtainium phase. Look at the industrial landscape. We are moving into an era of AI, green energy, and advanced robotics. What do all these technologies share? They are silver vampires. You cannot build a Tomahawk missile, a solar panel, an EV relay, or a 5G tower without silver. It is the most conductive metal in the known universe. There is no second best. Here is the technical reality that the experts miss: the thrifting wall. For the last decade, solar engineers worked miracles to reduce the amount of silver paste used in each photovoltaic cell. They thrifted the silver content down to save costs. Analysts assumed this trend would continue forever. They were wrong. We have hit the limit of physics. In fact, the trend has reversed. The new standard in solar technology, Topkin and HJT cells, are vastly more efficient at capturing sunlight, but they require more silver per unit, not less, up to 50% more. So, precisely at the moment when mine supply is collapsing, the industrial demand curve is going vertical. A solar manufacturer cannot substitute silver. If they switch to copper, the panel loses efficiency, degrades faster, and fails to meet warranty standards. They are trapped. If silver is $30, they buy. If silver is $100, they buy. Their demand is inelastic. They will bid the price to infinity because without silver, their billion-dollar factories produce nothing but glass and plastic. This industrial panic is exacerbating the retail shortage. We are hearing whispers from the supply chain that major industrial users are now bypassing the COMEX entirely. They are going directly to the miners, to First Majestic, to Pan American Silver, to the giants in Mexico and Peru, and they are signing offtake agreements. They are buying the metal while it is still in the ground. Do you understand the implication of this? It means the silver that is supposed to flow to the COMEX vaults, the silver that backs the paper contracts traded on Wall Street, is never arriving. It is being diverted at the source. The COMEX is becoming a ghost exchange. It is trading receipts for metal that is already bolted onto a solar array in the Nevada desert or sitting in a strategic stockpile in Shenzhen. And this ties directly back to our previous analysis of China and the BRICS nations. While the US Mint is halting sales, the Shanghai Gold Exchange is draining the West. The arbitrage is wide open. Smart money is taking delivery of physical bars in London and New York, melting them down, recasting them into kilogram bars, and shipping them east. This isn't just about making money, it's about sovereignty. The BRICS nations are actively building a payment settlement system to bypass the US dollar and SWIFT. To do that, they need a neutral reserve asset. Gold is the Tier 1 asset, but silver is the transactional industrial blood of the new economy. China knows that in a multipolar world, he who holds the gold and silver makes the rules. They are trading their treasury bonds, U.S. debt instruments that are losing value, for hard assets that are essential for the 21st century economy. This is a geopolitical liquidation of the dollar system, disguised as a commodity bull market. The U.S. government knows this. The designation of silver as a critical mineral wasn't a suggestion, it was a prelude to control. When you see the U.S. Mint stop selling, you have to ask, is it incompetence or is it hoarding? Are they out of silver, or have they been ordered to stop releasing it to the public because the Department of Defense needs every remaining ounce for the next generation of hypersonic missiles? And where is the new supply? The mainstream economists will tell you, high prices cure high prices. Miners will just dig more. This is the greatest fallacy in resource economics. You cannot print silver. You cannot code it into existence. Global silver production is in a structural, irreversible decline. Mexico, the world's champion producer for centuries, is seeing its grades collapse. We have mined all the easy silver. We are now processing tons of rock to get mere grams of metal. And the political climate in these regions is turning hostile. Nationalization threats in South America, environmental blockades in North America. The supply isn't coming to the rescue. It takes 10 to 15 years to open a new mine. If silver goes to $200 tomorrow, it will still take a decade to bring new supply online. We are facing a lost decade of deficits. So what happens next? We move to a bifurcated market. This is critical to understand if you want to protect your wealth. You are going to see two prices. Price A is the spot price. This is the fictitious number shown on CNBC and Bloomberg. It might show volatility. It might even dip if the manipulators try one last paper smash to trigger stop losses. Price B is the street price. This is the actual cost to acquire physical metal in your hand. We are already seeing the spread blow out. If spot is $66, but the cheapest coin you can find is $85 or $90, then the spot price is a lie. As this crisis deepens, that spread will become a chasm. Eventually, the spot market will become irrelevant. It will be a museum exhibit of a failed financial system. The U.S. Mint halting sales is the canary in the coal mine. It is the government admitting, without saying a word, that the strategic asset is gone. And there is a darker angle we must consider. The strategic critical mineral designation implies that in a national emergency, civilian ownership becomes secondary to national security. We could see executive orders. We could see 1933-style confiscation rhetoric, or more likely, windfall profit taxes on precious metals. But the most probable outcome is an export ban. The U.S. may simply forbid silver from leaving its borders to protect its defense industry. If that happens, the global market fractures instantly. The price in London, the price in Shanghai, and the price in New York will disconnect completely. The chaos we are seeing with the U.S. Mint today is just the first tremor. The earthquake is the default of the COMEX. Imagine holding a contract that promises you 5,000 ounces of silver. You waited years for this price move. You stand for delivery, and the exchange sends you a letter declaring force majeure. They tell you that due to market irregularities, they are settling your contract in cash. They will pay you the paper price, but you cannot buy metal with that paper because the real price is double. That is the rug pull. That is how the system resets. They settle their debts in worthless currency while keeping the real assets for themselves. This is exactly what happened in the nickel market on the LME. They canceled the trades. They rewrote the history of the day to save the insiders. Do not think they won't do it to silver. The difference is, when silver breaks, it takes the credibility of the dollar with it. The suspension of sales at the mint is your final warning signal. It is the sound of the drawbridge being raised. The fortress is locking down. Those who are inside with their metal are safe. Those who are outside holding paper promises are about to be slaughtered. Do not look at $66.40 and think, I missed the boat. $66.40 is cheap. In a world of hyperinflating debt, unpayable liabilities, and physical scarcity, silver has no ceiling. It only has a frantic repricing to reality. The silence from the U.S. Mint speaks louder than any Federal Reserve press conference. The metal is gone. The ledgers are bleeding. And the great default has moved from theoretical to operational. The only question left is, do you hold the title to the metal, or do you hold a claim on a bankrupt system? Because when the mint closes its doors, the panic doesn't end. It begins. The window to act is closing faster than the market realizes. The U.S. Mint has made its move. The Shanghai Exchange has made its move. Now it is your turn. If this report helped you see through the fog, hit the like button so this intelligence reaches more people before the blackout spreads. And if you are not subscribed, click that button now. We are tracking the physical vaults daily, and when the next major default signal flashes, you need to know immediately. Don't be a victim of the reset. Be prepared. I'll see you in the next video.